Gold and silver just detonated into a new price regime, and a lot of people are already rushing to file it away as just geopolitics because that explanation is convenient, simple, and, most importantly, non-threatening to the institutions that live off orderly markets. But the breakout isn't being driven by emotion. It's being driven by structure. And the hidden detail the mainstream keeps missing is that the market isn't only repricing the metals, it's repricing immediacy. That sounds subtle? It's not, because when immediacy gets repriced, spreads tighten, inventory becomes a weapon, and the paper market starts behaving like it suddenly remembers the physical market exists. Stay with me, because in a few minutes you'll have 3 things you can actually use. The one signal that tells you whether this move is real or just a blow-off, the 2 levels that matter over the next week or 2, and the checklist that tells you what breaks if this momentum is forced to unwind. And that's where the real pressure starts. Right now, the headline numbers are loud enough to distract you by themselves. Gold has been pushing record territory around the mid-4600s per ounce and was reported near about $4,173 today, while silver has been ripping into the mid-90s per ounce, also tagged around $94 today. In just the first half of January, the tape has been a staircase. Gold printed roughly $4,125 at the start of the month and moved into the 4600s, and silver went from the low 70s to the low to mid 90s. That's not a gentle drift. That's a market that is pulling liquidity forward. And here's the part most people gloss over. When something moves that fast, the story you're told is almost never the story that matters. Because the why that gets published is designed for broad comfort. The why that moves markets is designed by constraints, and constraints don't care what anyone believes. The crowd is being handed a clean narrative. Safe haven bid, geopolitical tension, tariff threats, currency nerves, people reaching for something real. Sure, those are sparks. But sparks don't become infernos unless the room is already filled with gas. The gas in metals markets is always the same mix. Positioning, leverage, inventory optics, the futures curve, and the quiet mechanical flows that don't show up as sentiment until after the fact. And that's why the next detail matters more than any headline, because it tells you whether you're looking at a one-day event or the opening chapter of a squeeze that can outlast your patience. Let's start with the street symptom, the thing you can feel before you can quantify it. When a physical market is truly loose, you don't hear the same words repeated across the chain. You don't hear allocation, you don't hear extended delivery, you don't hear premium, you don't hear people talking about what they can't get, only what they can buy. But in tight metals phases, those words crawl out of the woodwork, and then suddenly everyone pretends they've always been there. That's because physical tightness doesn't announce itself with a press release. It announces itself with friction, small delays, higher premiums, dealers hedging less aggressively because they're not sure they can replace what they sell. And that's not the part that matters. The part that matters is what that friction forces the futures market to do. Because futures are supposed to be the clean, liquid, elegant layer on top of the messy physical world. If you want exposure, you buy the contract. If you want to hedge production, you sell the contract. If you want to roll, you roll. Neat. But when the physical layer tightens, futures stop being purely a price chart and start becoming a system for rationing what's immediately available. And the rationing doesn't happen through a headline. It happens through the curve, through spreads, through what traders are willing to pay to be in the front month rather than 3 months out. And that's where the real signal lives. Here's the hidden detail that reframes this entire breakout. Pay less attention to the spot headline and more attention to what the market is doing with time. When a market starts fighting for the near month, that's a flare, because it means someone is either 1, worried about access, 2, worried about settlement mechanics, or 3, seeing an arbitrage that only exists if the front is tight. Any one of those is bullish in a different way. And when they start stacking on top of each other, it's how you get explosive moves that keep going even after the news cycle changes. But that's not the part that matters either. The part that matters is the inventory story embedded inside that curve behavior. Because inventory is where the paper world meets the real world and has to stop pretending. Let's talk inventory the way professionals do, not the way social media does. Inventory is not one number. Inventory is categories. Inventory is location. Inventory is deliverability. Inventory is ownership. And the most important split, especially in exchange-traded markets, is the difference between metal that is deliverable against futures and metal that merely exists somewhere in a warehouse system. In the comics world, that often gets simplified into registered versus eligible. Registered is the deliverable pool, metal that has been assigned a warrant and can be used to meet delivery. Eligible is metal that meets the specs, but is not currently registered for delivery. People love to argue about this like it's a conspiracy versus a debunk. One side says, registered is falling, the exchange is doomed. The other side says, eligible can be converted instantly, so stop panicking. The truth is less dramatic and more useful. Yes, eligible can often be converted, but conversion is not a law of physics. It's a choice, and choices depend on incentives. And incentives change when price moves violently, when volatility spikes, and when you're not sure you can replace the metal you tender. That's the whole game, and that's where the real pressure starts. So when you hear inventory draws, don't just picture metal leaving a building like boxes on a forklift. Sometimes it is withdrawals. Sometimes it's reclassification. Sometimes it's metal being pulled out of the deliverable pool because the owner prefers optionality. Sometimes it's being moved to private channels. And here's the key. Regardless of the reason, when the deliverable pool tightens relative to open interest, the market starts charging a premium for certainty. That premium shows up as spread behavior. It shows up as people paying up for the front. It shows up as the curve flattening or inverting. And even if you never see a single warehouse report, you can often see the pressure in the way the market trades around roll windows and delivery windows. That's why the calendar matters. That's why now is not a vibe, it's a schedule. And this month, the schedule is doing what it always does during tight phases. It magnifies small imbalances into big candles. You get thin liquidity moments. You get positioning shifts into month end. You get options expiry gravitational pulls. You get people rolling at the same time, which means liquidity thins right where you need it most. And then one sharp move forces hedging, which forces more buying, which forces shorts to reassess, which forces the market to gap, which forces everyone who hesitated to chase. That's the reflexivity loop. And once it starts, the tape stops behaving like a calm market and starts behaving like a crowded theater with one narrow exit. But here's the twist. The exit is different for different participants. For some, it's closing a short. For some, it's buying protection. For some, it's finding physical. For some, it's shifting collateral. And each of those actions pushes in the same direction at the same time. That's why moves become explosive. Not because the world ended, because the plumbing got tight. Now let's make this concrete with the price context, because you need anchors. Gold started January around the low 4300s and ran into the mid 4600s. Silver started around the low 70s and tagged the low to mid 90s, and it's been described as up roughly 30% on the month. Those are not normal monthly moves in mature liquid benchmarks unless something is forcing behavior, and this is where the conflict comes in. The force trying to suppress or deny the move isn't a cartoon villain twisting a dial. It's the entire incentive structure of orderly markets. Dealers want two-way flow, not one-way panic. Funds want liquidity, not air pockets. Policymakers want confidence, not a screaming signal that currency credibility is under negotiation. And precious metals, when they run this hard, are a billboard that says, the market is pricing something you don't control. That's why the narrative machine goes to work immediately. And that's why you can't outsource your understanding to the loudest explanation. Because if you do, you'll get whipped out by the volatility, even if the thesis is right. And that's where the real pressure starts. So let's talk mechanism, because mechanism is what keeps you from being emotionally hijacked. There are three mechanical engines that can all be running at the same time in a metals breakout like this. 1, physical versus paper tension, expressed in spreads and delivery preference. 2, options reflexivity, expressed in dealer hedging flows. 3, macro regime shifts, expressed in real yields, currencies, and reserve psychology. If you can see which engine is dominant this week, you can stop reacting to every candle like it's a verdict. Start with physical versus paper. Futures contracts are claims on metal under a rulebook. In normal times, those claims trade with minimal friction relative to spot because arbitrage keeps the relationship tight. If spot gets too high relative to futures, someone can sell spot and buy futures, or vice versa, depending on cost of carry, financing, and logistics. The carry trade smooths it out, but when metal is hard to source or when the deliverable pool is perceived as less available than the headline warehouse total suggest, the carry trade gets riskier. Financing isn't free. Borrowing metal isn't free. Locating bars isn't instantaneous. And during stress, the market starts pricing the risk of, I can't get it when I need it. That risk premium shows up as near-month strength. And near-month strength is what pulls the entire curve upward because the curve is a chain. Tug hard on the front link, and the rest of the links follow. But that's not the part that matters. The part that matters is what that front-month strength forces shorts and market makers to do. If you are short futures, because you're hedging production, or because you're a systematic strategy, or because you're a market maker facilitating flow, you're not just short a price. You're short a set of obligations. In quiet times, you can roll. In volatile times, rolling becomes expensive because spreads move against you. And if the front month starts trading like it's scarce, you're faced with a nasty menu. Pay up to roll, pay up to cover, or post more margin to stay in. And margin is not a moral judgment. It's a mechanical constraint. When volatility spikes, margin requirements can rise. When margin rises, leveraged players sell what they can, not what they want. That can cause sudden dump candles even in a bull market. That's why you can have a thesis that Wes right and still get destroyed if you size it wrong or if you can survive the shakeout. The market is not trying to teach you a lesson. It's just clearing its own risk, but it feels personal because it hits your emotions. And that's where your psychology shield matters. Hold that thought, because before we get to the psychology shield, you need the second engine, options, reflexivity. This is the part most people either overcomplicate or ignore. Here's the simple version. Options dealers often try to stay hedged. If customers buy calls, dealers may end up short calls. If dealers are short calls, they can hedge by buying the underlying futures as price rises to stay neutral. That hedging demand is not bullish sentiment, it's forced buying. And forced buying has one defining characteristic. It doesn't stop because the chart looks extended. It stops when the flow stops. That's why certain levels matter so much, because big strikes act like magnets. When price approaches a cluster of strikes, hedging flows can accelerate. If price clears that zone decisively, the hedging can shift from stabilizing to chasing. That's how you get the kind of vertical behavior that looks irrational after the fact. It's not irrational, it's hedging math, and that's not the part that matters. The part that matters is what happens when the move pauses. Because if price stalls near a strike cluster, dealers may unwind hedges, and that can cause abrupt pullbacks. If price snaps back below a key level, the same reflexivity that pushed up can pull down. That's why you must treat metals in this phase like a volatility product, not a sleepy store value chart. If you anchor on gold always goes up as a personality trait, you'll panic sell a dip and then watch it rip without you. If you anchor on this is manipulated as a personality trait, you'll ignore real invalidation signals and hold through a reversal. The correct posture is identify the signals, respect the volatility, and size to survive. Because if you can survive the noise, you get to participate in the trend. And that's where the real pressure starts. Now the third engine, macro regime. People say rates like it's one dial. It's not. Metals respond to real yields, to currency credibility, to reserve behavior, to the shape of risk appetite, and to the market's belief in policy competence. In a world where gold is making record highs while the dollar can still have strong weeks, you're seeing something important. The bid is not purely anti-dollar. It's pro-hard asset. It's pro-optional insurance. It nests the market paying for a hedge against tail risks that don't attach to have clean pricing. Tariffs, trade fragmentation, geopolitical escalation, fiscal questions, sanctions regimes, and the who holds what reserves corporate chessboard, those forces can all create a persistent bid for neutral assets. Gold is the neutral asset. Silver is the higher beta cousin that also sits in industrial supply chains. And when gold moves first, silver often plays catch-up with violence. That's not a guarantee. It's a recurring pattern driven by liquidity and positioning. Silver is smaller, more volatile, more reflexive. It tends to overshoot. And overshoots are where fortunes are made and accounts are blown up. Same move, different outcome. That S, why this next detail flips the whole setup. Silver is not mined like a faucet you can open. A huge chunk of silver supply is byproduct supply, tied to mining of other metals. That means supply response is slow. Even if price screams higher, you don't magically get a flood of new silver in a week. Recycling helps, but recycling has its own constraints. Collection, processing, economics, time. Refining has bottlenecks. Logistics has bottlenecks. And industrial demand doesn't politely pause just because price is inconvenient. So when silver runs, it can run into a supply chain that can't respond quickly, and the market's tool for rationing becomes price. That's why silver's breakouts are often explosive, because the supply chain can't veto it in real time. It can only respond after the fact. And by then, positioning has already shifted. Now stack the proof. You don't want one argument, you want layers. Layer 1. Price action is not a drift. It's a stair step into record territory with sharp daily ranges. Layer 2. The calendar is lined up. Roll windows, month-end positioning, options dynamics, meaning liquidity is thin exactly when flows are heavy. Layer 3. Physical market language and behavior tends to tighten during these phases. Premiums, delivery times, allocation, friction that often leads futures to price immediacy. Layer 4, the inventory concept itself, deliverable versus non-deliverable, matters because it changes what the market fears. Even if eligible can be reclassified, owners won't always do it if they prefer optionality or if replacement risk rises. Layer 5, institutional flows, ETFs, and large allocations turn interest into mechanical demand because creations require metal sourcing and hedging decisions. Layer 6, macro backdrop is not just one headline. It's a regime of uncertainty where neutrality is valuable. And that's not the part that matters. The part that matters is whether the structure confirms it this week. So here, So how you translate all of that into something you can watch without getting hypnotized by candles? You track three things: the behavior on pullbacks, the behavior of the front end of the curve, and the behavior of volatility around key levels. Behavior on pullbacks tells you whether dips are being bought by players with time horizons longer than a day. If pullbacks are shallow and quickly reclaimed, that's strength. If pullbacks slice through prior breakout levels and fail to reclaim them, that's weakness, or at least a reset. Front-end curve behavior tells you whether immediacy is still being priced. If the market keeps paying up for near-month exposure, that's a sign of continuing tightness or continuing stress. If the curve relaxes, spreads widen, and near-month urgency fades, that's often where momentum cools. Volatility behavior tells you how the market is trying to shake people out. In tight phases, volatility is weaponized, not by a villain, but by the natural dynamics of leverage and hedging. Spikes force margin. Margin forces selling. Selling creates dips. Dips trigger fear. Fear causes retail liquidation. Then the market resumes. That cycle repeats until it doesn't. And the moment it doesn't, when the dip doesn't bounce, when the reclaim fails, that's your invalidation signal. And that's where the real pressure starts. Now let's be honest about the counterpoints, because credibility lives here. A market can be in a real bull phase and still deliver vicious drawdowns. In fact, the more real the phase is, the more violent the shakeouts can be, because there's more leverage to flush and more hedging to unwind. Also, when metals scream higher, authorities and exchanges can respond through risk controls, margin changes, volatility curbs, position management. That doesn't kill a bull thesis by itself, but it can change the path. It can force a reset. Another counterpoint: if the dollar strengthens sharply, or if real yields spike, metals can get hit, even if the longer-term story remains intact, because the market will temporarily reprice the opportunity cost of holding non-yielding assets. Another counterpoint: profit-taking is real. Funds that rode the move will sell some. Trend followers will rebalance. Risk parity will adjust. That creates air pockets. None of this is a reason to be bearish by default. It's a reason to stop thinking in a single straight line. The market doesn't owe you a smooth trend. It owes you volatility. And if you don't plan for that, volatility will plan for you. This is your viewer psychology shield. Listen closely, because it's the difference between being right and being paid. When a market enters an explosive phase, it will try to emotionally manipulate you in two directions. First, it will try to make you feel late right before it pulls back. You'll see a vertical candle, you'll feel urgency, you'll feel the need to not miss it. That's when your size tends to get reckless. Then it will pull back fast, and it will try to make you feel stupid and trapped. That's when your mind starts bargaining. Maybe the top is in. Maybe it was all hype. Maybe I should just get out. That's when weak hands sell to strong hands. The market doesn't know you. It doesn't target you. But the pattern is so consistent, it feels personal. Your defense is simple. Separate trend signal from noise. Trend signal is higher highs and higher lows held above key breakout zones, plus continued structural tightness in the front end. Noise is intraday spikes, wick hunts, headline whiplash, and social media certainty. If you treat noise like signal, you'll churn yourself into exhaustion. If you treat signal like noise, you'll ignore invalidation and hold through a reversal. The goal is not perfect prediction. The goal is structured decision-making under stress. That's the whole game. Now, what comes next over the next week or two is best framed as two scenarios. Scenario one is the controlled pullback and retest. Price cools. Volatility stays high, but becomes more two-sided. Because continuation squeezes can reverse sharply once the forced buying exhausts. The key in a squeeze is not to predict the top. It is to respect that the path is jagged and that your risk plan matters more than your opinion. And that's where the real pressure starts. So what would confirm the thesis that this is being fueled by real tightness and structural repricing, not just a one-off panic bid? Watch for three confirmations. 1. Break and hold behavior. Not just a tag, a hold. When price breaks a major level and then treats it like support on pullbacks. That's confirmation that buyers are not just chasing, they're defending. 2. Continued strength in silver relative to gold after pullbacks. In real metals, bull phases, silver tends to lead on momentum bursts and then hold enough of the gain to keep the ratio pressured. If silver gives it all back while gold holds, that can signal the move was a liquidity event rather than a structural squeeze. 3. Continued front-end firmness. Signs that immediacy is still being priced. You don't need exact inventory numbers to understand this. If the market keeps acting like the front matters more than the back, the pressure hasn't left. And what would weaken or invalidate it? Again, keep it practical. Invalidation is not a red day. Invalidation is failure to hold the breakout zone and failure to reclaim it quickly. If gold breaks down through the prior support region and then rallies back into it and gets rejected, that's the market telling you the regime is not being accepted at these levels, at least not yet. If silver slices through its recent launch levels and can't bounce, That's telling you the move was overextended and the unwind is in progress. Another invalidation signal is if the curve relaxes and the urgency fades, if the market stops paying for immediacy and starts acting like carry is comfortable again. When comfort returns, squeezes lose fuel, and when fuel fades, the market either consolidates or corrects. That's not bearish forever, it's just the cycle. Now, let's address the institutional angle without turning it into a cartoon. Institutions donatise need to manipulate us a market for the market to behave in ways that feel suppressive. Market makers manage risk, banks manage exposure, funds manage volatility targets, exchanges manage systemic risk, policymakers manage narratives. All of those incentives lean towards stability. When metals run, stability is challenged. So what happens? You'll see commentary that downplays the move. You'll see it's all geopolitics or it's all speculative. Or to this, you'll see people telling you it's over right before the next leg, and people telling you it's going to the moon right before a shakeout. Both extremes are designed to harvest your attention. Your job is to harvest signal, because if you can stay in the middle, disciplined, skeptical, mechanism-driven, you become the kind of participant the market doesn't easily shake out. And that is a real edge. So here's the near-term checklist I promised, the one you can actually run without living on a chart all day. First, identify your key support zone in gold as the area the market must defend to keep the breakout accepted. Given the move from the low 4300s into the mid 4600s, that zone is likely going to feel like the first serious pullback region below the highs, where buyers should show up if they reel. Second, identify your key support zone in silver, where the market ES momentum either holds or cracks. Silver ES move into the low to mid 90s after being in the low 70s. At month start means the must-hold zones are going to be obvious in hindsight. Dante, wait for hindsight. Mark the recent launch points that created the last acceleration. Third, watch the character of dips. Are dips instantly bought or do they grind lower? Instant buys suggest urgency and tightness. Grinds suggest comfort and distribution. Fourth, watch volatility. If volatility is rising while price holds, that's often squeeze behavior. If volatility is rising while price breaks down through support, that's often liquidation behavior. Fifth, watch for narrative traps. When you see everyone suddenly agree on one simple explanation, that's usually the moment the market changes tempo. And before we land this here, amongst the subtle CTA that doesn't teabag, if you market the kind of investor who refuses to outsource your brain to headlines, if you want the mechanics, the structure, the what to watch next, instead of the dopamine, then you are already in the right crowd. Stick with the people who care about spreads, inventory categories, and positioning, not just vibes. That community mindset is how you stay sane in insane markets. Final thought, and it's the one most people ignore because it's not exciting. Price can whip around violently even if the thesis is correct. Metals can be right and still be brutal. The market can punish you for being early, punish you for being late, and punish you for being right with the wrong risk plan. So treat this like what it is, a structural breakout with real mechanical fuel, but also a volatility machine that will try to shake conviction out of you. If the market keeps pricing immediacy, if pullbacks are defended, and if the curve keeps acting tight, then the breakout is not just a story, it's a regime. If those signals fade, respect it, reassess, and live to trade the next setup. Because discipline is how you stay in the game long enough to catch the moves that actually matter.